Lead Lag Live is thankfully getting some really good momentum on Spotify and Apple and all that good stuff. So stay tuned for that. My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Emil Kalinowski. Emil, for those who are not familiar with your background, talk about who you are, how'd you get involved in markets, why the fascination with Jeff around the Eurodollar side of things, and what are you doing now?
Thank you very much for having me on, Michael. This is fantastic. I always wanted to be on the radio, and now I am. Modern day 21st century radio, international broadcast. Fantastic. I work in the metals and mining industry, and I was asked to explain why prices are moving up, down, and around in circles. And I thought it might have something to do with supply and demand at first. But eventually I realized, no, that does not explain what's going on. It has to do with capital flows, the movement of money in and out of commodities and all other asset classes. And I was reading Michael Pettis's book, The Volatility Machine, from the year 2000, and he was talking about how globalization came and went 6 times since the year 1800, and it was started and ended every single time by a surplus or a deficit of money. And then it clicked. The money we're talking about in modern day is the money that Jeff talks about all the time in his writings, the Eurodollar system. So I made a concerted effort to read his work every single day for a month. A lot of people on the air right now would be able to read it for a day or two and understand what he's saying, but I did not. So I had to commit for a month. And eventually it sunk in. And I realized that he had the thesis that explained the last 15 years, basically, which is there's not enough money in the world. And because of that, our economy, our society, our politics have all been trending, and our health, it's all been trending downward. And this has happened before. And each time it happens because we run out of money. And of course, the people that are listening right now may say, but the central banks are printing. But that's what we talk about. Maybe they're not really printing.
Okay, so there's a lot to unpack. You mentioned Michael Pettis. I had him on a space not too long ago talking more about China, but I want to explore this idea that there are cycles when it comes to globalization and the idea that it ends based on there not being enough money. First, this is going to sound like a really strange question, although it's one that I think a lot of Bitcoin fans always like to address, which is how do we define money if the argument is that you're in a deglobalization cycle because there's not enough of it?
Well, that is the 500 trillion. What was the derivative total? I think so. Yeah. I think it's at 500 trillion right now. And it was heading towards a quadrillion before the global financial crisis struck. That is the question, Michael. How do you define money? That's the problem. It's a question that has not been answered by our central bankers in 50 to 60 years. They can neither define, identify, measure, or map the creation or collection of money across the world. And that is why they stepped away from adjusting the money supply, impacting money demand. And now they hope to do that indirectly through forward guidance, narrative, raising interest rates, sending messages to banks who then are the ones that control money. So how do we define money? It is at the highest level, it is the private bank balance sheet, both on balance sheet, what we see, and off balance sheet, what we don't see. And that is the economic money that drives the world. And it had been expanding exponentially for decades until 2007, at which point it went sideways, and it's gone sideways ever since. And so have so many of the fields that we're concerned about: economics, finance, politics, society, sideways.
Okay, now, and I will say, it's interesting in the context of currency movement that we're in an environment where there's high inflation, but the dollar is acting like there's not enough dollars, right? So I do think it's an interesting complication in terms of how to think about inflation, money supply, and the perceived scarcity, at least on a relative basis, compared to the euro and the yen. I just did a interview with good folks at Wall Street Silver, and we were talking about gold and silver and the role of gold as a commodity that's important for the historical context of thinking about money. And because your focus is on metals and mining, you need to obviously be aware, as you noted, around where capital flows are going. One of the things which has been arguably quite frustrating in this last decade plus environment of unrelenting QE is that despite all this narrative of all this money, gold really hasn't done as well as people thought it would. Now, I want you to talk about, from your vantage point as an analyst in the metals and mining space, why is it that precious metals haven't performed better when, speaking about narratives would seem to suggest that it really should have?
Exactly. Now, we may think something's broken with metals, precious metals. Something is wrong, that they're not working if there's all this printing. What if it's the opposite? What if the metals are right and there isn't printing? Let's go back to that money idea. Each of us, I was a little bit too abstract and not specific enough. Each of us deal with money day to day. We can look into our purses, our billfolds, and we see money in there. Coins, bills, coupons, debit cards, right? These are all different formats of money, and they're all different levels of power and liquidity. Coins, that's money, not very useful in day-to-day life, is it? The laundromat token, very useful in one specific location, the laundromat or the subway token. But can you use that money to buy food? No, you're going to have to jump through some hoops. And that same idea is in wholesale finance, international finance. You start with bank deposits, and then you move up to capital market assets, derivatives, foreign exchange derivatives, swaptions, all these fancy things which I can say, but God knows how to trade them or what they mean or who's buying and selling these things. But it is all money and liquidity. And it is this high-powered level of money that's so hard to define and identify and measure and map that has been stagnant for 15 years. Meanwhile, the money that is being, quote-unquote, printed by central banks out the wazoo are the pennies, dimes, and quarters. Bank reserves, that's the lowest level of money. It's who can use it? It's a laundromat token. You know who can use it? You can't use it. I can't use it. A bank can use it when dealing with another bank or the central bank, but it doesn't ever filter out into the rest of the economy unless the banks say, yes, we can do it. And by the way, quick digression, the whole Eurodollar system, which we'll get into, grew up without any bank reserves. So you don't need them. Banks do not need them. Bankers love to make money. They will make money if there's money to be made. So the question is, how come gold and silver have been somewhat stagnant and disappointing with all this printing? The answer is there hasn't been printing. What there has been a lot of jumping up and down by central bankers, flapping their arms and saying, we're printing in the hopes that the economy will take off because they see all this printing. So there's all this liquidity. So therefore the economy will rebound. They're hoping for self-fulfilling expectations. It's very disappointing that our central bankers are still doing this. QE was invented in Japan, or at least implemented, and for the first time in modern history, in 2001. There have been numerous studies showing that QE does nothing. So I don't know why they keep doing it. It's not money printing. It's a laundromat regulatory token that banks use, but no one else in the real economy does.
And you know, to your point, I mean, you can use that as sort of a reason for why the velocity of money has been in this incredible bear market on its own, right? Because you haven't had, despite all of this, you know, public perception of money printing, much usage of it in terms of transactions and that money moving hands.
Yes, that would support the argument, but I'm going to say that the velocity, we cannot measure properly the velocity of money because we don't have the full picture of money. We do not know what each bank is doing intra-quarter, right? We are told what their positions are at the end of the quarter. After they've dressed their books, made them pretty, put on some lipstick, eyeliner, beautiful books, right? Okay. But what's going on during the quarter? We have no idea. But that's where all the money creation is taking place. Some of the regulators, they may get reports weekly or monthly, I guess. But we don't get the real data as to what's really going on in these banks. We know the regulators are behind. So if we don't have a full picture of banking activity, and we're just talking about onshore banking, right? Banks talking to banks onshore, or onshore banks talking to offshore banks. What about the offshore banks talking to offshore banks existing in lightly regulated jurisdictions? No idea. Who has any insight into that? The BIS. That's a lot of words. I can't pronounce that correctly. The Bank for International Settlements. They'll do a great job, and I love their data, and it's usually 6 months behind. So we don't have a full picture of what money is, where it is, and therefore, how can we rely on that formula, which says, well, the amount of money in use is slowing down? Well, we don't really know because we're not measuring all the money. All we're measuring is M1, M2, and M3, whereas money goes into M4, M10, M infinity.
Okay, so now you touched on the Eurodollar side. Again, I did this with Jeff Snyder, but I want to have it come from you for the audience. First of all, talk about why the Eurodollar is so important to the global financial markets, and what are some of the disconnects that you're observing here?
Michael, by the way, now I'm going to dive in face first into discussing the Eurodollar. The Eurodollar system, what is it? It's the monetary order. It's the thing that we rely on to fund the global economy. And it's in this, you know what it's like? It's like dark energy and dark matter. It is the thing that explains the supermajority of the universe, of the energy and the mass in the universe. So scientists tell us. Obviously, I'm not a physicist and I don't know, but this is an analogy I like to use. They tell us it's some 96% of energy and mass in the universe. And of course, the idea is it's dark. We can't measure it. We don't know what it is. We don't know. We can only observe its effects on other things. And that's how we figure out it's even there. That's what the Eurodollar system is. It grew up sometime in the 50s. We don't know exactly where. Japan, Switzerland. Where else? Oh, there's some country I always forget. Montreal. I know that's not a country. Forgive me, Canada. The city of London. And it was bankers saying, you know what? We need dollars. That looks very bright, but we don't have physical dollars, or at least they're pretty hard to come by, and we can't print them. Now, we can get some, but you know what we can do? We can promise our customers that we will get them. And because we have a wonderful building with an impressive granite facade, people will trust us. We've got the biggest building in the city. People will believe us. So we promise to get you dollars if you need them, but you don't, because all we're transacting in is wholesale finance, and you don't actually want to take possession of pallet-full bricks, pyramids of dollars. Okay, what you want to take possession of is an adjustment to your ledger balance at the bank. We'll say that your bank deposit improved by X dollars or whatever when we give you this loan. So they, through the stroke of their pen, as Milton Friedman said when he was explaining what the Eurodollar system is, through the stroke of a pen said, you now have this many dollars in your account. We've loaned them to you. And this person would go and transact with those dollars, international finance, trade financing, whatever it happens to be. And banks would do this. The network effect built up in the 50s, slowly but slowly. But by the early 1960s, there was a well-known investigative reporter, the financial reporter of his day. And of course, his name is escaping me at this time, but he has got this great quote from the early 1960s who wrote that quite by accident, Paul Einzig was his name, quite by accident, he stumbled upon this Eurodollar system, and the bankers he spoke to begged him not to write about it. It was veiled in a cloak of secrecy. Bankers creating dollars out of thin air. And slowly but surely, the Federal Reserve started noticing, hey, there are all these dollars appearing that are not under our control. They're appearing overseas. Where are they coming from? Well, they weren't actual physical dollars. They were just ledger balances denominated in dollars that were promises. And these started to network, multiply, and were growing exponentially in the mid-teens, in the low 20s, compounding year after year, decade after decade. That was the 70s. And it just kept growing and growing. And this is what the world relied on to finance international trade, international activity until 2007, when the bank said, well, we can't trust this anymore. The things that we thought were money good no longer are. And the key is this was taking place offshore, lightly regulated, required no bank reserves. So if the Federal Reserve said, we're raising the reserve requirements, the banks abroad internationally can say, we don't care. We don't report to you. We're offshore. We're going to keep as many reserves on hand as we think prudent, and as our customers and our lawyers and internal lawyers think prudent. But we're not relying on you. And so, of course, it grew to such proportions that it grew well beyond the control of central banks. And this was the topic during the 60s, 70s, and 80s. The regulators, the bankers were saying, where's all this money coming from? It's beyond our control.
So let's use the 2007 marker. And I know you've made this point that you believe that we've been in this silent depression. And the term depression obviously has a specific meaning from an economic perspective, but obviously depression also relates to emotion and and happiness and sort of the well-being of the mental psyche of a society. I want you to talk about your thesis of why there's been this silent depression, how that Eurodollar excess supply or made up supply, whatever you want to frame it, interplays with that, and then bring that to today in the context of this currency volatility we're seeing.
I won't know how to do that at the end, the currency volatility. I guess you'll have to help me. I guess the thesis would be the dollar milkshake thesis. That would be my answer for volatility. There's too much debt. Most of it's denominated in dollars. It's the safer ones. And so we're rushing into dollars. Okay, but let us go to the silent depression. Why is it silent? It is silent for the same idea is, does a tree make a sound if it falls in the woods and there's no one there to hear it? Well, the same thing with this depression. Does the depression make a noise if the financial media, business press, and politicians ignore it? I guess not. I guess it's silent. But it is the third worldwide depression of the past 150 years. The first one was the Long Depression, 1873 to 1896. That one kicked off, just like all the other depressions, not necessarily worldwide ones. There are other depressions that are not worldwide. The Latin American 1980s, that one also included Africa. That was a depression for them. But okay, so the worldwide ones, the other depressions, why does it happen? There's not enough money in the system, and the economy grinds to a halt, contracts, and then never recovers previous growth rates. It stays stagnant. Perhaps it has a reflation, a recovery of some sort. Very shortly thereafter, another downturn, another down leg, and we're back to where we were before. Just very miserable growth for a long period. And this is the third one. The second one was, of course, the Great Depression. This one began on August 9th, 2007, at about 1:14 a.m., when BNP Paribas sent out a note saying that they cannot value 3 of their money market funds. And you can see it in a number of different data accounts. Everything went to hell at that point. The global financial crisis had begun. We thought it would just be a recession, but it turned out not to be just a recession. Why do we know that? Because foreign direct investment never recovered back to the levels they were in 2007. We're in 2022. That's 15 years. Global trade is higher than it was in 2007, but a little bit. The growth rate is pathetic. If you look at the growth rate before 2007, it was exponential. The one right now, meh. Same thing with our economies. Britain, and God bless everyone who's listening to us now that's in the Commonwealth, and may long live the king. That's very sad that the queen died. But Britain, Australia, Canada, the United States, these are all countries that are experiencing such poor economic growth over the last 15 years that they are actually in a worse position today than they were during the Great Depression and the Long Depression. All 4 of those countries, 15 years in from the start of 2007 or 1929 or 1873, you measure how much GDP growth there has been, GDP per capita, and we are worse off than we were during those depressions. I could keep going. There are international surveys of happiness, never recovered to the 2008 level. There are international surveys of faith and democracy. Thousands of people surveyed, tens of thousands, never recovered to the 2008 highs for faith and democracy. The Economist does a survey, freedom in the world. 2008 was the peak, never recovered. Here's a damning one. Fertility rates in advanced economies. Women were having more and more children. 2008 came, precipitous decline, no recovery. The women obviously sense, what is a leading indicator other than the ladies deciding whether or not to have children and what the economic outlook and the situation looks like. Precipitous decline, advanced economies. It took place in 2008. So it's a depression, and it's been in place for 15 years. Coincidentally, it began when we ran out of money, just like the other depressions.
And I know for the audience that may sound odd, but if you consider the fact that all of this Fed activity since the great financial crisis, despite what looks like growth, has always been a strange dynamic. But if you really did remove all of that QE1, QE2, QE3 twist, that you'd probably see the real ugliness of what really happened beneath the surface. I think it's sort of the argument you're making.
Michael, can I add a quick point before we move on? Because you said the growth. And the key is a lot of people, when they think of depression, they think, well, it's just going to be a worse recession. And a recession is, we've been told, a contraction. So therefore we think, well, the depression is just going to be deeper recession, continuous contraction in economic output or employment or all the other things that our economy does. But that's not actually the case. Look at what happened during the Great Depression. It lasted from 1929, I say to 1947. Other people can disagree. If you say 1939, that's fine. Look at the Long Depression, 1873 to 1896. Did the American or the British, Canadian economies, did they contract year after year after year after year? No, they grew sometimes. They grew. It wasn't a contraction every year. Just like right now, we've been growing since 2008, and it's pathetic, and it's miserable, and it's unacceptable, and it's the lowest, slowest growth rates in 150 years. And I would say take a look around society, politics, and you would see that people are not satisfied. It's not enough just to be above zero. As humans, that's not enough for us. Who was the first editor of The Economist? Walter Bagehot. He said more than once that John Bull can stand many things, but he cannot stand 2%. 2% return is not good enough. Well, same thing applies in economic growth. And I would say just look to our politics. We've got all over the world people looking for solutions, going to the right, going to the left, going back to the right, to the left, looking for more extreme solutions. Who's going to set this right? Something's wrong. They're looking for outsiders, populists, authoritarians, Visigoths, Vandals, the Goths. It's perfectly natural in a depression.
Yeah, and I think it's a fascinating way to frame it, because it goes back to the start of the conversation that maybe gold has been right in not having a tremendous move, because maybe gold has seen that there really isn't enough capital in the system, which actually gets you out of the prolonged depression, right? I think it's something I myself want to think through a little bit. Let me get some of the audience up here.
I would say, I hope so, but jump in if I'm not making any sense. I would say the scarcity is from the point of view of the private sector, the households and the businesses. There's not enough lending being done to them. There's lending that's greater than zero, but not at rates that we've come to expect. And right now, lending is the way that we create money. That's what propels our economic system. I'm very worried that I'm not answering your question, Victor, but I would say the scarcity is from the perspective of the private sector, the households and the corporations.
Well, and you can also argue that the scarcity, is manifest in terms of the widening wealth gap, right? That it's scarce for the vast majority of the population.
Definitely. And when was the last time we saw this wealth gap? The Depression. It's perfectly natural and common for wealth inequality to expand during depressions. Why? The wealthy always have money, always have art, wine, violins, stamps, gold, silver. They've always property, businesses. They're wealthy. It's the everyone else that cannot keep up because they're not being given the money, the lending, the credit. Who will banks lend to during a low liquidity, highly uncertain future? Only the safest counterparties, only the people who don't need the money. That's why our monopolies, Google, Apple, etc., can get money for it's quote unquote free because banks will be happy to give them money because they know they'll pay it back. But everybody else, mom and pop, medium-sized businesses, etc., it's a slog, it's a difficulty. And that's where the inequality expands because the well-to-do are managing just fine while everyone else is suffering with the scarcity. Michael, I think you really helped hone in on the nuance there. I think that helped answer the question. Thank you, Michael.
Yeah, no, and I want to dovetail that a little bit to the name of the space because on Twitter, everyone always talks about the energy crisis in Europe, which obviously is very significant and should be talked about. But I myself, given the way that government yields on the long end, and I'm not just talking about my hell, which is the interaction of treasuries to stocks, treasury yields spiking, treasuries having a bigger drawdown than equities in an equity drawdown. It's not just U.S. phenomenon. It's, you're seeing it in Germany, you're seeing it in Japan. I wonder if that point about the scarcity on the private side is showing itself in the way yields are acting, right? And I know you wanted to talk about, this kind of European debt crisis that you think may be on the horizon. I certainly think we're probably already in it because I don't see how the ECB can possibly fight inflation without bringing back from the dead the pigs, right, from 2011, right? But I want you to talk through that thesis here for the audience.
I would love to, but I'm so nervous now because Velina Chakarova just joined, the geopolitical analyst herself right out of Austria. So I'm embarrassed. I'm going to be talking while she's listening. Okay, here we go. So here's the idea. The good news is, here's my hope, is that we are at the end of the beginning. Yes, this could be the end of the beginning, the end of the QE era, the end of central bankers being the ones trying to solve this silent depression. And we may be now entering, and Europe may be first, the period where the politicians take over monetary policy and direct money into the economy. It can sound distressing and stressful, but that's
but isn't it already
better
happening
than
with Lagarde? And right, I mean, you can argue that's very obvious, right? It's seemingly already taking place.
Good. Well, I hope so, and I hope it takes place with greater gusto. I hope the politicians. I'm surprised they didn't take advantage of it during the year 2020 when COVID struck. But very quickly, here's the thesis. Europe is going to be in its fourth or fifth recession since 2007. I don't understand how the people are not rebelling. And I know they are, actually. And I would think that the politicians looking to be reelected will now ensure that the market prices that are unfair to people are not allowed to take place, and that they will commandeer banks and direct credit to areas that will help the voting public. So into energy, into universal basic income, whatever it is, basically guaranteeing bank credit that keeps the debt off the government books while at the same time creating actual money. You see how we're bypassing the central bank. We're not creating bank reserves, which the banks don't put to use. We're going directly to the banks, the politicians are, and directing them to send that money into the economy to wherever the politicians would want it to go. Isabel Schnabel gave a speech in the beginning of 2021 called the Sovereign Corporate Bank Nexus, which is that idea. And this energy crisis may be finally, hopefully, the trigger whereby politicians step into the breach to try to help people and wrest the monetary policy away from central bankers. And here's the idea. Where can we see this first? We're going to see this first probably in the countries that are on the cusp of a private debt crisis. Which countries are those? France is one. Sweden is another one. They have had a tremendous amount of private debt in their system, and that's very unstable. When an economy slows down, the debt servicing costs are going to be too high. The stock of debt was grown too quickly relative to the size of the economy. I'm doing an abbreviated version of the Bank of International Settlements Early Warning Indicators of Private Debt Crisis. And they put those out every quarter. And if you take a look at them and do some analysis, you'll see which countries in Europe are looking like they're in trouble already heading into the crisis. The crisis hasn't even begun.
That's good. Let me reset the room for everybody here for the remaining 20 some odd minutes we're going to be doing this. Everyone, please make sure you follow Emil and check out his YouTube channel where he does a lot of interviews and has a lot of thoughts on his YouTube channel. Again, my name is Michael Guyad, publisher of the Lead Lag Report. And I would add to that real quick, and we'll go to you, Emil, for some thoughts on this. But this is what's been bothering me about this Treasury sell-off in the context of a very strong dollar. I don't believe this horrendous collapse in the risk-off safe haven can be explained by the Fed alone or even by inflation alone. There seems to be something else happening. I had somebody say in a tweet to me that I lived long enough to see treasuries be the riskiest asset of all investable assets. And it makes no sense to me to make that case because the entire system is based on the cost of capital and in particular very long duration treasuries. And there's all kinds of anomalous behavior that's going on this year, which to your point, Howard, I look at that and I say to myself, is this an anomaly or is this the quote unquote moment, right? That you can argue the real doomsday people in the FinTwit community and the finance world have been saying was going to come inevitably. I mean, I don't know if you want to add some thoughts or respond to that, but it is something that even for me, I'm worried more about the sequence rather than the end game. But at some point they kind of merge.
Just two quick thoughts, because I know we have lots of listeners and not too many minutes left. I would say that I don't think it's the Titanic analogy is the right one, because that was a catastrophe and most people died. Am I right? We'll make it through this depression just like we made it through the other ones, and it'll be unpleasant. But on the other side will be a new era, a new golden age ahead of us. So not quite the Titanic, but it is going to be a crucible through which we have to suffer. And as for this sell-off in bond yields, yeah, I guess so. I would blame the central banks pushing up short-term rates like maniacs because they see quote-unquote inflation, consumer price increases, and they think that by pushing up short-term rates, they'll combat this supply imbalance in petrochemicals and gas and natural gas and oil and supply snafus. It's wild. So bond market is reacting to central banks who are interested in public relations and looking good and saying we're doing something, even though they have little to do with what's causing these consumer price increases. And the people that I trust, Michael, you just had him on, Lakshman Achuthan, Economic Cycle Research Institute, Daniel Want from Prerequisite Capital, Keith McCullough from Hedgeye, they're all forecasting that the downturn is still ahead of us. We haven't even begun the actual economic downturn worldwide. So you would think then the bid will come into highly liquid, safe assets such as we're seeing with the dollar. And I would expect the bond yields to be coming down.
Yeah, and I would add history suggests that that's the case. So when you look at major drawdowns in treasuries, they tend to precede major drawdowns in equities. When I said back in 2020 on MarketWatch, first bonds, then stocks, I was obviously wrong in the timing, but the argument was bonds would crash and then stocks would crash coming out of COVID. This has been obviously a little bit desynced in that behavior, but there is an argument. You just had the biggest drawdown in treasuries in history. So whether or not that means you're going to have a horrendous equity decline or not, I'll tell you in a couple of years. But history does seem to suggest that that is a sequence that is worth paying attention to, which is why this could play out for longer.
I really appreciate that because that was completely not on my radar and I won't be able to comment intelligently about it in any way. I'm looking at private debt loads in Italy and those seem fine, but there's more nuance to it, just as you pointed out. And fantastic. So I'm going to look into that and thank you for raising it to my attention. Michael, do you have anything on that one? The other thing
I think there was a headline, and you can verify that. Wasn't there a headline, or I just saw it on the periphery, but there were some protests around paying electricity bills in various localities in the Eurozone. I mean, that's one way to get non-performing loans, right? If people protest higher bills by just not paying them.
Absolutely fabulous question. And it would be the latter. I use this joke often, so forgive anyone who's heard this before, but there are 5 forces in the universe: the weak and strong nuclear forces, the electromagnetism, gravity, and bankers' greed. Bank regulations, laws, don't worry about it. If there's money to be made, banks will make it. And my example is the Eurodollar system's birth was in response to tremendous regulations, straitjacket regulations, post-World War II financial repression regulations that would curl our toes. And the bankers found a way around it because there was money to be made. Right now, yes, regulations have increased and it's tougher. I'm very confident that they would figure out a way around, through, over, under these regulations to make the money if they believe that the return would be worth the risk. And I don't believe they do. I did not intend to say that bankers are bad and regulations are good. I am ambivalent about both. My joke was that's their nature. They want to make money, like the scorpion that stings the frog crossing the river. That's just their nature. There's nothing to be made up more of it, good or bad, other than that. Bankers are interested in making money, and my only complaint would be that you don't give them enough credit. You're saying the regulations are holding them back. I say, to my point again, of the Eurodollar origins in the 1950s, the financial repression, I am not exaggerating, was straitjacket style regulations, controlling capital controls, price controls, rent controls, whether or not you can take out credit, whether or not you can issue equity, overwhelming. And the bankers found a way through those because they saw there was money to be made. And that was what became the Eurodollar system. So I believe they would do so again if they thought it was worthwhile. And I don't believe they think it is worthwhile. Too risky. The first question, I don't believe maybe the other side, maybe the other bifurcation of the world. Yes, we're bifurcating. It's going to be a struggle. But I think that the dollar will remain strong. I don't think I answered your question entirely. What do I see? I think the dollar will remain strong even if the other half of the world doesn't want to use it. I believe during these kind of moments we'll experience conflict. So I don't think I'm answering your question. Your second question, yes, it could be digital ledger technology. It could be absolutely that Michael Pettis book I referenced at the beginning, the one that was called The Volatility Machine. It was written in the year 2000, and Michael went over 6 previous deglobalizations and globalizations. And ladies and gentlemen, would you believe that they were associated with a new monetary order? So either the demonetization of silver or the illegal use of gold or the introduction of the Eurodollar or other monetary innovations take place during these sort of crisis moments. Could it be digital ledger technology? Yeah, it could be. I don't know, but the chances are good that when this depression is over, there will be a new monetary order system. I have no idea what it'll be. If anyone does, let me know and we can make an investment, a small, profitable investment.
I feel like I should just say Satoshi to give a shout out to the Bitcoin maximums. But go ahead, Emil.
Wow, fabulous. First of all, for the audience who's thinking that, wow, what a jerk I am, that the first lady that comes on and immediately he starts talking about his Speedos. A, yes, I'm a jerk, but B, it's because they're both swimmers. That's why. Too central to fail. I love that idea. I believe, yes, it will be there. It's too big to fail. You can't let this spin out of control and threaten the euro currency and European project. Therefore, I think that we're moving towards hopefully. I'm just so tired of living in this zombie state. I'm saying hopefully we enter a new phase, one that gets us out of this depression, even though I know it'll be dangerous. But I think we're moving towards a Russell Napier-like thesis whereby governments bail out central banks, private businesses, and households by commandeering wealth, by putting up capital controls, by going back to what we experienced after the Second World War, those sort of financial repression techniques, and directing capital towards quote unquote productive uses to save us from these emergencies, save us from the financial emergency, the food emergency, maybe the health emergency, maybe the climate emergency, on and on and on.
Everybody, please make sure you follow Emil, check out his YouTube channel, subscribe to that, obviously, as well. And Emil, any final thoughts? Because I don't want to end the space on the narrative around Speedos.
Again, how dare you? You haven't even seen me in my Speedo.
I have no intention to.
Wow. Okay, let me see. What am I going to... Well, you've got me flustered. You've got me blushing. Michael, this was a great experience. And if anybody found even a moment of what I said interesting, then you will be thrilled with my show, which is where I don't even say very much, and it's a much more interesting person, and that's Jeff Snyder, where we talk about the Eurodollar system and the economy and where we're heading. And you can find that at eurodollar.university or on YouTube. Just search my name. And that is it, Michael. Congratulations on your success. Thank you again for hosting me, and it was a thrill. Thank you, dear audience, for listening.
Thank you, everybody. Thank you, Emil. Thank you, everybody. Cheers.